Let's bring in David Zervos. He's the chief market strategist at Jefferies. David, it's great to see you again. Welcome.
Always good to be here, Kelly.
This is about a week or so. Remind me, how much feedback have you gotten to the idea that basically there's, and I've had the same thought, by the way. Why is it that we've seen this unprecedented steepness and these enormous rate hikes, and yet nothing crazy's happened? Like, the worst thing that's happened is, FTX, and that's not even related. So your theory is all of the bad assets that would have triggered things like Orange County's bankruptcy in '94, those kinds of things, those terrible MBS paper, for instance, it's all on the Fed's balance sheet. Have they themselves absorbed all of the junk out of this market?
Well, I wouldn't just say the Fed, Kelly. The Fed's balance sheet at the peak was $9 trillion. It's down to $8.5 or $8.4 now. The ECB's is $8.8 trillion. The Bank of Japan's is $6+ trillion. Then you've got the UK, you've got Scandinavia, you've got tons of other G20 countries that have all engaged in the purchase of, in general, long-dated fixed income assets. That was what QE was, right? Drive long rates down when you get to the zero bound. And we sat there and decided somehow, I'm not exactly sure why, although I have my suspicions, that it was a good idea to leave these big balance sheets in place and first raise rates and then sort of just let them trickle off. But what's happening now is, because the inflation fight has been so aggressive and rates have had to go up so quickly, there's massive losses on these balance sheets to the tune of multiple trillions of dollars when you add them up across jurisdictions. And those are losses that would have otherwise been in Orange County or in a asset manager or on a bank proprietary trading desk back in 1994 or in long-term capital management or somewhere else, and they're not. So there's all these gains, which is the consumer locked in a low rate, a corporate locked in a low rate. Anybody sitting there with a 2 or 3% mortgage feels pretty good about themselves, but there's no private sector loss that would normally be there because it's been absorbed by these I want to call socialized loss structures inside of central banks.
And I think the interesting thing is to think about, is this even a bad thing, right? Because the losses are real, but they're not. They get to just carry them forward. So the Fed gets to earn its way out of those losses, and then eventually, so it doesn't really matter. I guess we can't even say that the taxpayer has to bear them right now. I guess they have to bear them in some way distributed throughout the future. But if you were a central banker, Dave, would you be sitting back going, wow, job well done? Or would you be saying, no, we should have shrank the balance sheet first, then done rate hikes, and then maybe we wouldn't have even had to have done as many, but maybe there would have been a lot worse fallout?
So I think it's a really tough question, Kelly. I think there's some goods and some bads, and you're right to kind of focus a little bit on the good, that we've got a more financially stable structure. But then you question, what happens to sort of the Fed's credibility or the Fed's political credo when it's going up in front of Congress and having these large losses. And now it's actually getting net interest margin losses. These are permanent losses. I think we're up to about 40 or 50 billion now in losses because they're paying out more on reserves to banks than they are receiving on coupon income from the portfolio. So politically, that's not a great place for the Fed to be. It has made a lot of money over the last decade plus, over $1 trillion. But these mark-to-market losses, which you're absolutely right, they don't have to take, seem like they're a bit larger than that now. And I just think that's got a bit of a sting to it. And it sort of, to me, would argue for asset sales earlier, something that I've argued a lot for in the past, or said I think it certainly made a lot of sense to me. But, we're past that bridge. It's over. It's done. We are where we are. And I will say one thing, Kelly, without getting too deep in the weeds. There are some central banks, like the Bank of England, that cannot take a loss. So actually the taxpayer has to fund the negative capital positions at the Bank of England. So in other, and I'm not sure about this, but I think Sweden also has some rules. So there are other countries that do it differently than us. And that could be quite an interesting drag on things. But for now, this is a major tailwind for the U.S. and I think helps explain a little bit why the massive losses in fixed income haven't really reverberated through financial markets or the economy as much as you might have thought.
I will say, so since I wrote up your piece, people have said to me, well, you should check some of the banks and make sure that, these aren't just hiding. So I'll just put that out there. But before you go, Dave, in the last kind of couple seconds we have, what do you think is going to happen at the next meeting? Then, based on what you're saying, do they have to keep jacking rates up a lot further than we anticipate?
So I think they could bring the balance sheet into it if they wanted to stop and figure out ways to get this sort of balance sheet lower faster. But they've already kind of that horses left the barn, so they're going to take the losses. I don't know that it's really that beneficial. But I think what we're saying, Kelly, is that this idea that there's rate cuts coming in 2024 or late 2023, probably a really silly idea. Maybe we have to go up a little bit higher, another 25 to 50 bips. Not, I think, 100 or 150 bips, but the whole distribution to me has shifted when you start to think about this difference in the loss structure. And it was, for me, a pretty big revelation because I was sort of done with rate hikes really toward the end of the year and feeling pretty confident that we were just going to sit for a while. Now I think we might have to fine tune it a little more aggressively to the upside. And if anything, there's a fatter tail to even much higher rates. I certainly never subscribed to the cut camp and thought that was a really silly idea. So I'm glad I got that. But I definitely have to ratchet up my thinking on where we could end up and how long we could end up there on the upside.
Dave, couldn't think of a better way to end it today. Thank you so much for your time today and for joining us.